What a day, what a day. We are again looking at a quick reversal in these markets. First, we get some inflation data, then we get the Fed. The markets digest them in quick succession and are left generally in good shape, but with a bunch more questions left to be answered, which is exactly what we're going to do here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to unpick what all of this means and where it leaves us from a very kind of bird's eye view here, and consider whether what we just learned and the seesaw that we saw in markets in its wake is in fact as benign as it might seem at first glance, or if there is something a bit more ominous setting up here. And so what we'll do first is we'll take a look at what's actually happened with the data that came out. We'll take a look at what the Fed has actually told us. And then we'll put all of that in the context of overall global growth dynamics. Because what we certainly don't have here is a blazing fire of concern, but the dynamics that set up here and the world that is to follow after today is an interesting one, and a world not without its pitfalls. So the first and most kind of important question that we have here is, with inflation lower and a Fed that seems not to have much confidence in its ongoing progress in that direction, hopeful though it is to gain it, is the central bank making a policy mistake? And if so, what might that policy mistake translate into? So first, let's set the stage a bit. We get CPI data that is, by all accounts, very positive for the case of bringing down inflation and for a central bank that wants to get its 2% inflation target into the crosshairs. Headline comes in at 3.3 versus 3.4% expected. The core comes down to 3.4 versus 3.5% expected, so better than anticipated readings all around. The month-on-month changes here looking even more encouraging. Here they are. You can see that the month-on-month change in headline CPI is actually 0. That's the first time in about 2 years that headline CPI doesn't go up at all. The increase in core CPI, which excludes volatile food and energy, and you can see that excluding it is an important step because, of course, you can see that most inflation here at this point is neither food nor energy. It is the service sector, which is mainly captured by that core inflation reading. That's the one that's really relevant. This is the smallest in about a year at 0.2%. All of it very encouraging. We can see that the annualized measures taken from the 3 and the 6 month changes, so the higher frequency trends in CPI, all very encouraging here. You're down from the prior month across all vectors. CPI 3-month and 6-month annualized lower from April into May. Core 3-month and 6-month annualized lower. So all of this certainly speaks to the idea that the Fed is back into a world where inflation is doing what it wants. And that, of course, very good news for the economy, for the markets. Not surprisingly, you get a very strong positive response from stocks. You get a very peppy response from the bond market. Bonds go up significantly. You also get a somewhat weaker dollar. You also get some strength in precious metals. And then the Fed comes out. Now, here, you don't necessarily get something that upsets the rally in stocks in a very meaningful way, but the dollar ends up giving away a lot of its losses and claws back a good deal of ground. In the bond market, most of the adjustment happens at the front end, but the front end bonds end up retreating off their highs back into familiar ranges. The long end holds up a little bit better, but yields dilute at the long end only a bit. The story after the Fed seems to be that whatever CPI implied, the reality is maybe less dovish. So yields end up being higher at the long end than the peaks after CPI, and or at the short end rather, and at the long end you get still a potent rise in bonds, but not as potent as it was in the immediate aftermath of that CPI outcome. So what happens here? Well, the press conference with Fed Chair Powell is perhaps not the most eventful part of this. It's this update of the central forecasting from FOMC officials that they update the summary of economic projections every quarter. This is really what everybody was waiting for. And the mix of numbers here is eye-catching. First of all, the brass tacks. The Fed funds rate for this year notched up significantly. So the Fed's gone from baking in 3 cuts in both December and March to now just looking at 1. If the median rate now is 5.3, down to 5.1 is 1 cut. And obviously we're rounding here. Higher rates next year as well. On net, what this amounts to is, in March, a cumulative 1.4% in cuts, revised to now 1.2% in cuts. Not only that, but the squeeze happens at both ends. So at the front end, 1 less cut. At the long end, also 1 less cut. Because this longer run rate, where the market is getting an estimate of what the Fed thinks is the neutral rate for rates, and basically says, here is the level at which policy is neither restrictive nor expansionary. Here's where it's neither stimulus nor contraction. That rate has now gone up from 2.5 in December to 2.8 now. It got increased to 2.6 in March. But from 2.5 to 2.8, that's 30 basis points. That's another cut taken from the longer end this time, and increasing the floor on borrowing costs, essentially saying whenever cuts do come, they're not going to go as far as they were thought to go ultimately. And there'll be fewer of them. So in essence, the Fed has squeezed the cost of borrowing to a less dovish setting from both near-term and long-term perspectives. What's interesting is that in doing that, it did not increase expectations for growth, and it only increased expectations for unemployment. Steady for this year, but higher for next and for 2026. And of course, overall. While it did that, it increased the forecast on inflation from 2.4 to 2.6, 2.2 to 2.3 next year. And then by 2026, ostensibly, we're at the target. So what we seem to be getting here, and of course the core was revised higher as well. What we're seeing here is a bit interesting. The Fed is saying growth will be no better. Unemployment will actually be higher, but inflation will be stickier. And so we will be able to cut rates fewer times, which is not nearly the optimistic story being told in the inflation numbers. In fact, it's sort of the opposite direction. So the natural question that then emerges is the Fed wrong to be this hawkish? Are they fighting the last battle here? Are they still paying too little attention to their own thinking from the beginning of the year, where they said, look, you just have to give these rates a little bit more time? Disinflation will continue. It will resume. Well, now it has, seemingly, but the Fed is much more cagey, perhaps burned by having called inflation a transitory thing that they were late to fighting at the start of this cycle in 2021, and now reluctant to make a call in the opposite direction, and therefore maybe overstaying on the tight end of things, sort of like they overstayed on the loose end before. And of course, this raises a very important question. If the Fed does over-tighten, and of course, we don't know that they will at this point, we'll have to wait and see. But if the Fed does over-tighten, if they hold too long and the economy weakens materially as a result, does that present a meaningful business cycle risk? Are we looking at then another recession fear, not because the Fed has tightened too much at the front end of this tightening cycle, but because they didn't exit it soon enough, because they weren't nimble enough on the way out, just like they were nimble enough on the way in? Well, initially, things seem to be looking relatively benign. U.S. economic data had been underperforming relative to forecasts since mid-April or so, but about the second half of May, things started to turn. And as we can see here, this Citigroup Economic Surprise Index has pushed through its 20-day moving average, which tends to typically suggest follow-through. So we're perhaps starting to look at the beginnings of a run where U.S. economic data is going to look increasingly better relative to forecasts for a while. We saw the beginnings of that with the PMI data, which was much better than expected, stronger across all vectors, manufacturing and services, and therefore, of course, the composite. We're, in fact, looking at the strongest overall growth rate for the U.S. economy in a year, if these numbers are to be taken at face value. The ISM data gave us something similar. Its view of the manufacturing sector was much more anemic than S&P Global, but it's services that's the main part of the economy, and here it saw robust strength. So overall, the U.S. economy seems to be doing okay. The Fed doesn't necessarily have any glaring reasons to think they're already overtight. The economy is not by any means looking like it's falling apart. But if the Fed does over-tighten as it later emerges in the final analysis because they overstayed, the risk associated with that is significant. Because if the U.S. economy were to have a significant downturn thanks to policy rates that remained too high for too long, there isn't really a plan B for global growth. As we've said here before, global growth is made up fundamentally of two halves. One split between the U.S., the Eurozone, and China, the three main engines of global growth, and the other half, the vendors for those three economies. there's a bit of muddle too, because China is in many ways a middle step in the global supply chain, a value add middle node that is then a vendor to the US and the Eurozone. So the lion's share of global growth is the US and the Eurozone end demand that powers value add driven growth in China, that then powers vendor economies in much of the rest of the world. We just saw data out of China this week suggesting at least that part of the key three economies is looking worrying. CPI data coming in weaker than expected, 0.3% year on year versus 0.4% expected, underpinning the idea that local demand is very much still anemic. So we can see here inflation has been hugging zero basically for over a year. And when things hug zero on the inflation front, that speaks to weak demand. When consumers have to compete on price for scarce goods, the price of things go up. Well, when the price of things can't go up, that speaks to the absence of that demand. Now, there was a little bit of a better story for the wholesale situation. So we can see here the PPI index coming in down 1.4% year on year versus 1.5%. So a little bit of a smaller negative number than anticipated. And that might suggest that we're getting a little bit better at passing through rising input costs for enterprises. So they're able to pad their profitability numbers a little bit relative to, let's say, a year ago. But this is not nearly the encouraging thing it looks like, because, of course, we can see it's still negative. And this entire time that this has been getting better, ostensibly, we've also seen only 3 months of expansion in the manufacturing sector, where much of this positivity lives. Looking at the PMI numbers here for this entire stretch, that this has improved, allowing for more pass through of rising input costs, allowing for enterprises to look a little bit better as far as the money they make at the wholesale price level. There's only been 3 times, here once and here twice, that the whole of the manufacturing sector managed to grow. So the slightly less bad spread on wholesale profitability is cold comfort, as it were. Meanwhile, the absence of domestic demand certainly stings. We can see here that for the past 2 months here, after the peak in March, overall economic activity has slowed in China, largely as the service sector, a proxy for domestic demand, has cooled. So the situation for overall growth is nothing to be terribly optimistic about. And as a matter of fact, the economic surprise index from China has been deteriorating basically since April. This is it right here, suggesting that economic data outcomes are actually getting worse compared with forecasts. And so the situation is not looking all that grand. To bring it all home, for 4 months in a row now, Chinese real GDP growth has outpaced nominal GDP growth, meaning that the price component of this, what gets you from nominal to real, nominal minus inflation is real, but so if real is above nominal, then what you're talking about is subtracting negative inflation from nominal growth. That's how you get to a positive real GDP growth that's in excess of nominal. But of course, that negative coefficient on the price differential tells you that China's economy is suffering from a deflationary overhang somewhere on the order of 1.5 percentage points of GDP growth, which is staggeringly bad and speaks to a near total absence of underlying demand. So at least one of these major three economies is in pretty bad shape. The situation is better in Europe. Eurozone GDP has been recovering smartly after a recession last year, or so the PMI data would have it. We can see the composite index has recovered and continues to accelerate in recent months. In fact, the first quarter was an increase of 1.3% in regional GDP, which is the best growth rate we've seen out of it in quite a long time. If we consider kind of the recent history here, the growth of 1.3% in the first quarter was the fastest since the third quarter of 2022, which was before the Eurozone economy settled into its kind of post-COVID digestion. Now, of course, manufacturing is still anemic, but the service sector, as in the US, is the much larger part of the economy, and that's doing quite well. However, we can see that this might be a catch-up after the slight recession that we had in the second half of last year that doesn't necessarily imply follow-through. Here's the annualized GDP growth rate. It's up a little if you squint, but it's still hugging zero. It is not exactly accelerating. In fact, we can see in the breakdown of the components here, even just with the naked eye, if this was the pre-pandemic normal, and this was the pandemic's damage, followed by this catch-up, all of this, despite the fact that the PMIs look like they're coming off their lows, this looks very anemic indeed across most vectors, be it consumption or investment or the external sector. And so what this is looking like is perhaps a European economy that had an acceleration after a downturn to effectively rebase and rebalance and normalize after that downturn, but that isn't necessarily accelerating in a perpetual forward motion way. In fact, when the ECB cut rates earlier this month, that was June the 6th, were investors to have thought that the economy is accelerating, they might have cheered it loudly and stocks might have been quite a bit higher. Reducing borrowing costs on an accelerating economy is, of course, akin to jet fuel getting poured on a fire. As it happens, Eurozone stocks actually fell about 4% since the ECB cut rates, as if to say, oh, we understand you're cutting because the economy is not doing all that great. And in fact, we can see here that after this brisk recovery in Eurozone economic data relative to forecast, which, by the way, notice this is July of 23, that nicely lines up with the timing of where this bottom occurs. This is about mid-2023 here. After this run-up, we've hit a wall and have since started to kind of cool off, suggesting lost momentum. All of which brings us back to this conversation. What if the Fed is over-tightening? What if it's not responding fast enough to the kind of signaling that we just saw in this very benign CPI report? What if it's fighting the last battle? If it over-tightens and the U.S. component of this pie misfires because the Fed has done too much, these parts of the pie are not lining up as an offset. So we are operating without a safety net here. And if the Fed gets it wrong, and the markets have very little economic data to chew on to suggest that it isn't necessarily between now And when the next update comes in September, there's, of course, assorted pieces of data, but nothing truly tectonic from the Fed zone perspective, aside from maybe the Jackson Hole Symposium in August. If the Fed has now basically painted itself into a hawkish corner, and that's too much, as it later turns out, then there really isn't very much of a backstop elsewhere. And a conversation about global recession might quickly come back to the forefront. It isn't there today. It isn't there yet. But the stage setting is something to watch very closely. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street's close and where that might lead us thereafter. I'll be back on later today on The Price of Truth with the great Victor Jones, back on with Chris for Futures Power Hour, and this week for Last Call on Friday. Back on with Victor for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. And opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money returns tomorrow. And, of course, The Price of Truth is on in just 30 minutes. Don't go anywhere.